Hey there, let's talk about why moving forward in 2022, FHA for the win. This is a product that I'm probably in most instances going to be recommending to my clients who are looking to purchase and have a little bit of down payment money, maybe not even enough for closing costs. But those people that have largely been shut out of the market the last couple of years because you and I both know it was almost impossible to get an offer accepted in Southern California if you didn't have an extra 50 grand to pay over or put 20 or 30, 40% down or pay all cash. So this is your time. This is your time, Mr. and Mrs. Buyer that have been waiting for the right time to get into a house. Now is the time to act. I'm going to share with you some tidbits about the FHA loan and some things that you may not have even known about the product that is going to benefit you moving on into the future. FHA loans are wonderful and serve many purposes for a lot of people because they're very generous with credit qualifying and they have the highest allowable debt ratios other than a VA loan, which you have to be a veteran to qualify for. So oftentimes we can get someone qualified, maybe even 100,000 higher than if they were purchasing with a conventional loan. One of the disadvantages to an FHA loan, just so you know though, is that if you're a condo buyer, we always get people qualified conventional and FHA, even if the FHA product is better, because a lot of condominiums they have to be FHA approved. And so if it's not FHA approved, you can't write an offer in there. But for the most part, FHA loans are a great product and we see a lot of benefits and uses for them. And I want to bring up this slide here so you can see what I'm talking about. Now, here's a scenario for a buyer, a first-time buyer that's looking to purchase, and we have the sales price at $650,000 for this example. And when we, the mortgage broker, are pricing out loans, we use a set of variables to price things out. And in this particular instance, that variable was a 720 credit score. And with a $650 sales price, you can see a pretty big difference in the FHA loan and the conventional. Let's take a closer look. So the FHA loan at the top line, it shows 3.5% down, a 4.375 rate, and the payment is $4407, and you need $35,000 cash to close. That is your that cash to close represents your down payment of 3.5%, and then closing costs. And you can, closing costs are legal third-party fees. Closing costs are twofold. Legal third-party fees only happen one time: escrow, appraiser, lender. And the second set of your closing costs are your taxes and insurance. In the industry, we call them prepaid, escrow, impound account. So that $35,000 represents your down payment and your closing cost. So let's go back and we look at the full thing again. So you can see that with the payment being $4407, it's much lower than the other two loan options. So if you're really looking to get in and have the lowest payment and you have $35,000, this is going to be the premier option for you if you're purchasing a $650 house. Now take a look at just below the FHA 4.3, there's a second scenario. And excuse me, a lot of people don't know that FHA has this really cool feature. We just have to raise the rate a little bit and we can pay closing costs for you. So maybe you don't have that $34,000 or $35,000. Maybe you got 20 grand or 22 grand, or you can get a gift from a family member. You can still do this home ownership thing if you don't have all of the money on hand. Now, obviously, if you do, it's a much lower rate, almost like $400 cheaper than the conventional option, and $450 for the option where we're paying the closing cost. Okay, let me go and make that bigger again so I can see it. I'll put in my glasses. Now let's look at the conventional 3% down. That has the highest rate at 5.75, $650 sales price, $47.87. versus the FHA one where we're paying 2% of your closing cost. So that is a little bit cheaper, and the reason is because the monthly mortgage insurance on conventional loans are a little bit lower, especially if you have like really high credit scores. Some people really just care about, hey, I want the lowest payment moving forward, and that is going to be your FHA loan, right? Number one, bar none. And then other people like, I don't want to pay that mortgage insurance or that higher premium. But you have to think about it. This is your first property. This is your starting out point. Most people don't keep the same loan for more than 4 or 5 years. And right now we're heading into a recession. Now, nobody has a crystal ball and knows when it's going to happen, but when it does, we're cautioning all of our borrowers that recession comes, in comes the government. Hey, government, we're going to save the day. And one of the ways that they save the day is through housing, through stimulating the economy through housing, because it's such a big ease on the economy, and it helps so much. And when they do that, they lower the rate. So you're purchasing right now, the rates are a little bit higher than they were a year ago, or gosh, even 4 or 5 months ago. That being said, let's take a look at this, because this is one of the reasons why I think this is such a great loan. If you look at the very bottom, I highlighted in yellow, later when we head into a recession, let's do an FHA streamline. And let's just say if the rate were 3%, the payment would go down to $39. So if you opted to have us help you out with closing costs and your payment was $48, and now your payment is going to be $39, that's almost $1,000 in savings. That's a huge amount of money to be able to save. And the reason you can do this is FHA has a feature. The only other loan that has it is VA. And basically you do a rate reduction in place. It's a very low cost way to refinance. Everybody, like the lenders charge less, escrows charge less, there's no appraisal. So everybody streamlines your rate in place for a super, super low cost. You barely add anything onto your existing loan balance, and you can just save money. Now, the reason why this is important is that when rates increase, historically demand decreases because affordability is diminished. So you have people that are like, hey, I'm going to wait on the sidelines. And you've got sellers that, are doing price reductions now as we speak. If people aren't telling you that, maybe it's not quite happening in their area yet. But right now, coming off of what we came off of the last couple of years, who was largely setting the price for their house was the seller. And so if they're interviewing 3 agents and agent A said, hey, you should list your house at $850, that's what the last one sold for, and that's what it's worth. And agent B came in and said, oh, you want to sell it for $900? Yeah, we can sell that house for $900. And so agent B gets the listing. Agent B sets the price at what the seller told them. And if it didn't sell, agent B just did a price reduction to sell it for what agent A said you should probably sell it for. And we've been going through that largely for the last couple of years. And then coupled with such low inventory, you have people that were paying $100,000 over. So the seller could technically say, yeah, I want to sell my house for $900,000, and they could sell it in many cases. That is not going to happen moving forward. A seller is going to have to listen to their agent, and they're going to have to price their property right out of the gate. As such, we are seeing a lot of price declines right now because sellers, thought they had a $900,000 house, and in fact, they had an $825,000 house. So moving forward, if you are purchasing and if prices do decline and you opt for this conventional product, right? Let's go back to this conventional product. You put 3% down. So if the price declines 3 or 5%, you will not have equity to refinance when the rates go lower. You will not have equity to refinance when the rates go lower because conventional loans do not have a streamline feature, right? That's an FHA feature. So I feel like if you're looking to purchase and we place you into an FHA loan, you're not only going to get the lower rate, you could possibly benefit from closing cost assistance and not have to wait another 6 months to buy that house and be stuck with rent increases, but you're going to be able to streamline that loan in place. So that's why moving forward, that's why in 22, I think the FHA loan is the way to go. Let's take a look at those payments one more time. Now, I really want you to take a look at the FHA loan at 5.5, where we're paying 2% closing costs. You only need $23,000 to make that happen. And, sometimes we can find a sweet spot. Maybe you don't even need the full 2%. Maybe you just need like 1.625%. And we can have the rate at like 5.25 or something. So it's really finding that sweet spot. And if you've got a 401k, or if you have some family that has been looking to, help you out, now is the time. Now is the time to get that 401k loan, to purchase your home, to get in and to leverage against rent increases. Those are our biggest enemy right now. Is the renters out there really suffering because rents went up 25% in Southern California. In some pockets, they went up 30 to 35%. And if you're with any corporate company, they raise the rents every year like clockwork. So let's get out there and make it your time. We can help you get your offer accepted now, right? That's something that's huge. Let us help you. My name is Teresa Timms. I'm president of TDR Mortgage. I've been helping homeowners since 1998. I'm a purchase origination specialist, and I'd love to hear from you. Like or comment below. I'd like to know your thoughts today. Have a great one.